Hello and welcome to this week's Market Matters video update. My name's James Gerrish. It is Thursday, the 28th of July, and this week I'm joined by our research lead, Shawn Hickman, and today we're going to go through some of the macro dynamics that are playing out across markets. So thanks for joining me this week, Shawn.
Absolute pleasure, James.
I'm going to start. There's obviously a screen of the Market Matters website there. We've done a few alerts this morning, so just trimming a couple of the overweight positions in our flagship growth portfolio, Goodman, Macquarie, and Aristocrat. We've made some changes to the emerging companies portfolio, and there's a couple of international equities that we're going to do tonight. So you can obviously see that on the Market Matters website. I'm going to go and crack straight into what we're seeing in terms of the ASX 200. We're going to look at the S&P 500, a couple of the key macro dynamic drivers out there at the moment, and get Shawn's take on those. So, straight off the bat, Shawn, we've got the ASX 200 here, currently trading at 68.62. What are you making of things at the moment, just from a broad perspective?
It's pretty much followed the roadmap, as a few of the markets have, that we've been outlining for the last few weeks or couple of months, really. It's had a good bounce back from the panic lows of June. Here we are around 6,900. I just think it's time to have a bit of a risk reward rebalance, have a little bit more cash. We were limit long for the last 4 or 5 weeks. We've now got about, I think we've now gone to 7% cash, give or take. Just have a little bit of flexibility if the market does have a look down on the downside. Market looks constructive. I think the market is looking for a low, whether it's found it or not. Probably go 50-50 on that one, James. Well, I think I just want to have a little bit of flexibility in there.
I think it's important to highlight to subscribers that picking market tops and bottoms is a pretty difficult thing to do. You get one right, you'll get one wrong, etc. So we're all about just playing the probabilities. So the market's bounced reasonably well from the lows. We had a 64 or a 6,400 low. It's bounced up around that 450 points from that low level. So we're looking at the probabilities, taking a bit of cash, and we're talking about the flagship growth portfolio here, putting a bit of cash back in the back pocket to then venture into domestic reporting season that will get underway. A similar sort of thing playing out in the US market, Shawn. So I'm just going to go to the S&P 500, but not surprisingly, that's painting a pretty similar picture.
Almost identical. I mean, we've had the big dynamic change in the last 24 hours. We had the results from the FOMC last night. They've gone less hawkish. I wouldn't necessarily say dovish. You could go that way. They're saying that interest rates might not go up as fast as people thought, which is exactly what we've been saying for a while. How much of that is built into the market is the hardest thing to know. But again, the market looks fairly firm short term. Bit of bad news, we could suddenly go deeper into recession fears. The market is swinging around between recession fears, inflation fears. At the moment, we've gone from inflation, the ball's been passed along to recession, and so rates don't look like they're going to go a lot higher. And we've been saying that for a while. I think the rates have overcooked it on the upside, and they need to stabilize a bit, and that's why we're seeing a bit of strength returning to the tech sector and the growth sector.
Yeah, I've got the chart of the US 2-year bond yield on the screen there. It dipped below 3% overnight. We've been calling it. Obviously, it had a high of 3.45%. We're now calling it or suggesting it's going to pull back to 2.5%. I think the commentary last night was really interesting from Jay Powell. Basically, removed or went away from this notion that they're going to raise rates no matter what. He sort of anchored it back to we're going to be data dependent. So that's what the market liked over there. We all know markets move aggressively on either side of the ledger. They often get too bullish, they often get too bearish, etc. We think that bond yields or interest rate expectations have firmed too much, and that's why we're saying a pullback in yields makes sense here. And one of the things we've done obviously we've got a reasonable tech allocation that we're in our flagship growth portfolio, but in our income portfolio, we've started to go into fixed rate bonds for the first time in many years. So from an income perspective, if you're an income investor out there, then certainly consider some fixed rate exposure. So that's the way we've been playing it, Shawn.
Yeah, makes total sense. And, when we're talking about the bond market, we're at 2.5% the upper bound for the Fed funds rate. I wouldn't be surprised if the 2-year yield has a look down, not because the 2-year yield is going to fall. It's just because we've got everyone positioned one way and we could see a bit of a washout. But as we wrote this morning, they're probably both at the right price today, both the local and the US.
I'm going to go back to the US market now, just because we're obviously in earnings season over in the US. It's quarterly earnings season. We've had about 40% of the S&P report earnings. About 70% of those companies have beaten, which is a bit below where they normally are. It's about 80% of companies beat over there. But given how optimistic analysts generally are, what do is there any trends that you're seeing over in US earnings that would be, which would be important for what we're going to see in the Australian earnings season?
Well, it's a bit like the bonds in that I just think the market got itself a bit overly negative the consumer in places. But everything's about earnings. We know that share prices move. They might move on a month to month, quarter to quarter basis with sentiment, but long term shares move, stocks move with earnings. That's what matters. And some companies are delivering, some companies aren't. Some of the advertising space we're seeing on the platforms is falling because a lot of small companies, a lot of big companies, just being a little bit more conservative, putting a little bit more money in the bank. Let's wait and see. Doesn't mean they won't kick it back in very quickly. So I think just cautiously makes sense. I think the trends are they're patchy. Is probably the right way to put it. They're patchy earnings, but they're not as bad as many feared, James, in summary.
Yeah, I totally agree there. So I've got Google on the screen there, and they actually reported after market the night before last. They obviously had the reaction to it last night. They are up pretty positively. What we're talking about in terms of markets moving ahead of news flow. So the markets have obviously, Google's been sold down from $150 a share down to or around just above $100 a share. So the market preempts this sort of slowdown or softness in earnings. So what we're saying is that the market's got very bearish, and this earnings season is not as bad as perhaps the market had feared. One area that caught my eye was around the property stocks. Property stocks have had the biggest beats versus expectations, low expectations over in the US. So the average beat is about 25% from an earnings point of view for the property stocks that are reported over there. So that could be certainly a trend that plays out in the local market.
Same thing again. I think people have got themselves incredibly bearish property, but there are lots of ways to play with statistics, as we all know. And people have got a lot more cash in the bank than they had before COVID. And sure, there's a lot of people are servicing slightly higher mortgages, and they're paying more for petrol, and they're paying more for price of goods in Woolworths. But there are scenarios out there that could change that in a heartbeat. I was just speaking to Natish about it a few minutes ago. You could suddenly see a resolution to the Ukraine war. Now that could be a 50-50 punt in the next 6 months. It's an awful situation, but if that was to be resolved, and we saw oil price could drop 20% on the back of that overnight, central banks would suddenly have all the inflation concerns. Half of them would go, and then we have the situation where the weather's improving so far. We've got the sun's out in Sydney today. It's quite a rare beast. And we could have a lot of the food prices lower. So sure, things don't look great on that front today, but it's not hard to envisage in 6 months' time ahead they could be better.
The energy side's an interesting one. So obviously the war has had a massive influence on energy prices. I would suspect, if you're thinking, I think you're right in terms of a big reaction short term if there was a resolution there. Not that I probably can't see one in the foreseeable future, but you never know. I still think it's going to be a case of there's going to be less appetite to buy Russian energy ongoing, so that tightens up the markets right around the world. And I think we're going to go into this. We've had a lack of investment. You saw Westpac came out yesterday saying they're not going to put money into, or they're going to reduce the loans they write to specific companies in that area of the market. I think that tightness is going to continue because we've had a lack of drilling, we've had a lack of investment in the space at a time when we're all going more towards renewables, which is a great thing, and that's what we should be doing. But in the short term, we've seen it in coal prices. Whitehaven coal's absolutely ripped over the last 18 months as a consequence of that. So markets get their back into a certain spot, and then they springboard pretty aggressively from it. I was looking, Shawn, today just at some of the online retailers. So Kogan came out with better results, and they've absolutely ripped. They're up 35%.
Just very quickly back to that comment about Westpac and the backing, not wanting to back the oil and gas. Well, of course, they're saying that just when all those oil and gas companies like Whitehaven Coal that you mentioned, they're printing money. They don't need to borrow as much as they did before.
I was talking. We've had a lot to do with Whitehaven over the years, and I mean they're going to produce earnings of about $1.90 this year. We bought the stock when we did at $1.50. So earnings per share in 1 year is going to be more than what we paid for the stock when we originally bought it. Unfortunately, we still don't own it. We couldn't go back. We may well go back into it, but it shows you how when we bought it, no one wanted to be there at all. It was one of those trades where we got a lot of heat coming through our information pipe.
Saturday questions were full of it. Sorry, I'm interrupting. There's a slight delay. But if we actually saw then a sharp pullback on any positive noise out of the Ukraine, and like you, unfortunately, I can't see a resolution, but you can't discount it. I think you'd buy them. You'd buy the pullback if it happened.
Well, I guess markets. The positioning in markets right now, like the theme this week that's really caught my eye is everything that's been held short. There's been a lot of short covering, a lot of short squeezes playing out. BNPL has been the case in point. CESL was up 95% yesterday. Obviously, Zip's run from 46 cents up to about $1.40. But we're starting to see it play out in some of these online retailers that have been absolutely hit. I mean, the moves are big, but they are coming off very low levels. So you look at Temple and Webster on the screen there; it's moved from $14 down to $4, and it's moved. It's not in the big scheme of things. It is a blip, but it shows you how market positioning plays out.
Oh, totally. And I think we alluded to it last week in one of the reports where we said, don't get too carried away in this short-term rally up towards 6,900 because it's being fueled by short covering of the dogs of the last year or the last 6 months. It doesn't mean it's not a sustainable rally, but what it means is we're squeezing people out of shorts, we're squeezing people out of aggressively underweight positions. Let's wait and see what happens after it all settles down. And again, that's what we've done with the growth portfolio today, just giving ourselves a bit of cash to see what happens when it all calms down.
One of the things we've moved into recently, we had reasonable positions in commodities earlier in the year. We trimmed them, and we're now sort of re-establishing back into that part of the market. We've added to bought Oz Minerals and a few other BHP added to BHP and Independence Group, and a few others were buying Pilbara and whatnot. So, what's your take on? Because that's a clear play going back in the commodities space. We've obviously got this looming threat of recession. The media is full of the R word. What's your take on? Give us your summation around the commodity space. Is it simply, are we trying to pick a bottom here?
No, if we were trying to pick a bottom, we'd own a lot more of them, James. I think we got quite aggressive when we sold into the panic buying around March and April. No one picks the top, as you mentioned before, but we got quite aggressive in saying, okay, that's enough. Enough's enough. They're not going to sustain these levels, and I don't think for a moment I thought copper would fall from 500 to below 325, but I did think it would go under 400. So we've had these aggressive pullbacks, and what generally happens is share prices, and we've talked about Oz Minerals, that's one of the ones we went into, they tend to go ahead of commodity prices. So with things like copper, I think, use a phrase I mentioned before, I think they're starting to look for a low. Have they found a low? Maybe not. Maybe we go into recession. But the reason to start buying back into this stock is very compelling. It's a good time to be mentioning it today because, Oz Minerals is up almost 7%. But it's because everyone's abandoned ship with some of these commodities. Now, if you said to me, where would I say, let's go all in? Well, if it made another low, you'd buy more as opposed to getting out. But as we've also alluded to, if it pops above $20, we might take a bit off the table because it makes us sound like traders. And I hate to sound like a trader because I'm not. I have been in my past at times, but that's decades ago. We're in a situation now, James, where stocks are rotating into quarter almost like they used to move over 2 or 3 years. And you've got to acknowledge that. You've got to say, okay, if Oz Minerals is going to halve, and it, with a bit of mathematics, it's very close to having halved. Does it justify having halved? We said at the time when it was near $30, it was too expensive. I think now it got too cheap, but it sort of is plumbing towards 15. Just simple valuations.
Totally agree. The concept there is when everyone's, when you're reading on the front page of the newspaper, the market's moved ahead of that. So, that's what some new subscribers may have difficulty understanding with Market Matters. We're looking forward. We're investing for what comes next, not what's on the front page of the newspaper at the moment. And I think that's a good way to end this week's Market Matters video update. Shawn, thanks for your insights. Thanks for joining us. We'll be doing regular updates like this. We'll be subbing in Harrison, you, and as the team builds from there as well. So thanks for joining us this week.
Absolute pleasure.